What if everything happening right now, Bitcoin's volatility, the Fed's sudden policy shifts and market cycles wasn't just chaos? What if it's all part of a plan? A strategy where the Federal Reserve could stop printing money, short the riskiest assets, and use your liquidity to fix inflation, and even pay off part of the national debt. And what if the entire crypto movement was never as decentralized as we thought? Let's unpack what might be the biggest financial play of the decade. Right now, the US is caught between two fires. Inflation is still too high. Debt is piling up faster than tax revenue can handle. Raising rates controls inflation, but makes debt harder to service. Cutting rates gives debt relief, but risks stoking inflation again. So what's the solution? You stop printing money. Let rates stabilize, and you find a new pool of liquidity to tap. Where? Crypto. Crypto thrives on risk, on momentum, on hope. And Bitcoin? It's become the digital gold of the new generation. But it's also volatile, emotional, and full of retail money looking for quick gains. Imagine if the Fed or aligned institutions took short positions across crypto markets. They let retail drive up prices first, build hype. Let the crowd believe rate cuts are coming. Let Bitcoin run toward $100,000 again. Then they trigger the crash. It doesn't take much. A hawkish Fed speech. New regulations. A sudden market event, an exchange failure, or a liquidity squeeze, crypto crashes, retail sells, panic sets in. Now think, where does that money go? It exits crypto. It flows into traditional financial markets. Treasury markets absorb it. Institutions scoop up assets at discount prices. Liquidity returns to the system, but under control. Inflation drops. Debt becomes easier to service. The system resets, all powered by panic from the public. Only those who sell, because eventually Bitcoin will recover. These cycles always do. In 4 years, it might hit $100,000 again. But by then, the majority of holders will have changed hands. Retail will be hesitant. Institutions will be dominant. The Fed already won. They used crypto to cool inflation, pull in liquidity, and unload risk without needing to raise taxes or sell more debt to foreign buyers. But here's the twist. What if Satoshi Nakamoto wasn't a rogue genius or a cypherpunk hero, but a government agent? What if Bitcoin was always a tool built to absorb global risk and retail capital during moments of crisis? It checks all the boxes. Scarce and attractive like gold. Transparent and trackable on a public ledger. Unregulated enough to let people onboard themselves, but volatile enough to crash hard when needed. Satoshi disappears in 2011 just as Bitcoin starts gaining traction. Never moves the coins, never shows up again. It's perfect. Let the people believe it's freedom. Let them buy in. Let them hold the bag. And when the time is right, let the system extract value from it. Bitcoin might not have been designed to replace the system. It may have been designed to absorb its failures, a digital shock absorber that resets every few years. So let's recap. The Fed stops printing. Crypto pumps. Institutions short to top. Retail panic sells. Liquidity flows back to the system. Inflation is cooled. Debt becomes manageable, and Satoshi might not be a myth, but a mechanism. If that's the case, then we're not just trading assets. We're participating in one of the most sophisticated monetary feedback loops ever created. The only question now is, do you know which side of the trade you're on?